The third element is equity. It simply means residual interest in the assets after deducting all liabilities. It actually represents the accounting equation. Assets is equivalent to liabilities plus equity, thus equity is whatever remaining from assets after deducting liabilities. We call that residual interest. And this represents what the owner of the business owns, or also known as owner's equity, especially for sole proprietorship or sole trader. Under equity, we have subclasses. Those related to the business, they are income and expense, and those related to owner of the business, that are capital and withdrawal. Like I mentioned earlier, equity is made out of 4 other sub-elements. Income and expenses, representing the transactions between the business entity and external parties like customers and suppliers of goods, and also transactions within the business itself, like with its own employees, such as when salary is paid. While capital and withdrawal represents the transactions between owner of the business and the business entity. Regardless of their relation to the business or the owner, these elements will affect the equity. That is, they will either increase the amount of equity or decrease the amount of equity. Capital and income will increase equity because this is when owner contributes to the business and the business generates its own wealth through the business activities. While withdrawal and expenses will reduce equity, since withdrawal means owner taking cash or other items from the business for its own use, and expense simply means the business is using its resources to generate income. Coming back to the definitions of the elements, income means we expect an increase in asset or a reduction in our obligation that resulted in a net increase in equity. Take sales of goods in a merchandising or trading business, for example. Is the sales an income to the business? The answer is yes, by the definitions of income. The business receives cash, which means there will be an increase in its economic benefits, that is an asset. And it results in an increase in equity because, like we mentioned earlier, an income will have a positive effect to equity. Income can be further classified into 3 other classifications. They are revenue, other income, and gains. Revenue is an increase in assets because of our main activities. For example, if an entity is in a business of selling cars, when it sells cars, it will record a revenue. Other income is an increase in assets because of economic activities that are not coming from the main activities. So if selling cars is the main activities of a business, and it has extra space in the office that is unused, and it rents it out to external party, the rental income is categorized as other income and not revenue, even though both will result in inflow of money to the business. And gain is when we sell our unused assets. For example, we have extra desktop in the office that we do not want to use anymore, so we sell it at a price higher than the cost of buying it. Then we have a gain. For expense is when we do economic activities that reduce the resources in our business or increase the obligations that results in a net decrease in equity. Let's say a business receives an electricity bill for the month. Is the electricity bill that it needs to pay part of the expense? The answer is yes, by definition. When the business pays the bill, it will reduce its economic benefits in terms of cash, and this, referring to the accounting equation, will decrease equity. Remember, an expense has a negative effect to equity. Under expense, we can also have cost or loss. Cost is what's spent to produce revenue. It can either be cost or expense. Cost is what we spend directly to earn revenue, like cost of buying cars from car manufacturer for a business that sells cars. And we can also spend indirectly to earn revenue, like paying the electricity bill of the business or salary for a clerk. That will be identified as expenses. Loss is the opposite of gain that we have talked about under income. That is, for example, if a business has extra desktop computer that is no longer in use and it sells at a price lower than the cost of purchasing it, the difference is a loss to the business. So, just to put everything in perspectives, we have all the 5 elements: asset, liabilities, and equity. Where under equity, we have income and expenses that are business related and capital and withdrawal that are owner related. By deducting expenses from income, we will get either profit or loss. And for withdrawals by owner, if we are sole traders and partnership, we call it withdrawal or drawings. For corporation, we call it dividends. Then we need to talk about recognitions of these elements. When we say recognition in accounting, it means record it in the book of accounts or in the financial statements of the business. If we do not recognize, we do not record. 2 requirements before we can recognize an asset or liability or equity. First, the events or economic activities and amounts related to it must be probable. How sure are you that it will happen and you will get that amount if we talk about an asset? Usually for assets, it must be probable, meaning you must be more than 50% sure that you will realize the economic benefits before you can recognize it. And for liability, it must be at least possible, meaning at least 50% sure about the events and the related amount before we can recognize it. This is to fulfill a general principle of prudence, that is, not overstating the asset and understating the liability. The second condition is it must be reliably measured, meaning we know the amount of value and it is a reliable amount of value. So before we record an item related to any elements of the financial statements, that item must fulfill these 2 general conditions first. So that is all about topic 2. In the next topic, we will discuss the core of bookkeeping, which is the accounting equation. Before watching the next video, again, do try the assessment provided for you in this section to test your understanding of the topic. Also, feel free to rewatch the video if you think you need to. Until the next one, thank you for your attention and wassalamualaikum warahmatullahi wabarakatuh.